Thank you, Agustín. Thank you for coming this afternoon. We're shifting gears a bit. It's a central banking afternoon. We're going to chat for about 30 minutes. And we have Governor Kuroda, who will be joining us for a set of remarks. And then after that, Governor Carney from the Bank of England will be back on stage with Axel Weber. Agustín, I know we don't have a lot of time, and thank you. You just flew in this morning, so I just flew in yesterday, so I know how you feel. Jet lag hits in about this time of day. But let me start by just one of the themes throughout the day is, how do you see the state of the economy? I saw you in February in Hong Kong. We were together in Zurich a few weeks ago. If you look at the shape of the U.S. yield curve, it's all over the place. Now, there was perceptions of Fed tightening 3 months ago. Now there's perceptions in the market's pricing in a substantial Fed rate cuts. How do you see the global economy, and how do you see central banks and perceptions of central banks positioning themselves?
Okay, well, first of all, thank you very much for inviting me here. It's always a pleasure to be in these IIF events. Well, I mean, the state of the world economy is okay, but it's a very modest okay. I mean, I think that we are in a very puzzling situation, a situation that lends itself to ask many very important questions. I mean, we're, for example, concentrating on advanced economies. We're at a point where pretty much all, if not, I mean, pretty much all or the vast majority of advanced economies are close or around full employment. But growth is very low, and inflation is absent. And we have been trying to push the economy mostly to aggregate demand policies, fiscal and monetary. And those policies are running out of steam. I mean, at the end of the day, if you think what the difference is between monetary policy and fiscal policy, at the end is who gets indebted.
Right.
If you do monetary policy, you reduce interest rates and you induce more indebtedness. Now, what we are seeing is households, corporations getting indebted, searching for yield, distorting many financial markets. And then fiscal policy, you see that slowly but surely indebtedness in many nations are increasing. So how much space, fiscal space we have, how much monetary space do we have, is probably not much. And therefore, it's important now to start thinking on the real policies that can really engineer higher sustainable growth. No? And I mean, I think that the Fed, for example, did a very good job a few years ago, starting with the normalization process. It was never meant to be easy,
Right.
And that's what we have seen. But so far, I think that the progress that they have made is welcome, because that gives them more room to maneuver. It's very difficult, and I don't think it's the objective of this conversation to try to forecast what the Fed will do next. But yeah, I mean, I think that they are in this transit towards a more normal circumstances in a situation where special inflation is not kicking in as it's supposed to do.
And are central banks the victim of their own success? The global community turned to central banks in the aftermath of the crisis for the traditional problems that fiscal authorities have a challenge with respect to timing. Are we still turning to central banks to provide demand-side management when we should be looking at either fiscal policy or, as Mario Draghi said at Jackson Hole 3 or 4 years ago, we need to also focus on the structural side, the supply side?
Well, I mean, certainly the latter is an absolute truth. I mean, I think probably, yes, central banks did a tremendous job. I think that we would not be where we are today if it were not due to the initiative and the courage to act of central banks. But in a way, I think we made it too easy for other authorities.
Right.
and therefore what they should have done probably has not been done. I mean, it's really telling that the crisis started 2007, it exploded in full 2008. It's more than 10 years, and we're still with very unconventional monetary policies. That's 10 years after the crisis. And we still are in a circumstance where in some countries we have negative interest rates. And should this be considered the new normal? Definitely I wouldn't say no. But that reflects the fact that other pieces need to fall in place, and the sooner we do it, the better.
And are you worried about the impact of extraordinary policy for this long, fueling potential bubbles in the future, whether it's in leveraged loans or in illiquid assets?
Absolutely. I mean, here, I mean, usually when we think about financial crisis, there is always an element of surprise. So I worry about what we know and also what we don't know.
Right, right.
There might be some bubbles brewing or some imbalances brewing under the surface that we don't see. But yeah, I mean, the search for yield is in full force. We see it with direct lending, leverage loans, CLOs, but also I worry about the more macro dimension of capital flows between advanced and emerging market economies, and what that might mean in terms of volatility.
So, and I know Mark's going to address on some of the capital flows issues in his presentation. So does this mean that macro-prudential needs to be more front and center with respect to the tools in your toolbox or for central banks?
Yeah, I mean, it really has been a race on how to complement our toolbox with macro-pru instruments. Now, the issue is that still we have some gaps. We don't have the facility or the easiness to implement a macro-pru on non-bank intermediaries, or it's far more difficult. In some countries, we don't even have the institutional arrangement or an agile institutional arrangement that facilitates the implementation of these policies. Now, I think in the last 10 years, if we revise the record, it has been impressive, no? But still, I would say that that it will not be a self-contained solution to the issues we're facing right now.
And do you worry about central bank independence? And going back to the point that we've become so reliant on central bankers to keep the drug of low interest rates and accommodative policy going, we see many politicians begin to attack central banks as they're in a more tightening cycle. Do you worry about central bank independence as something you and your colleagues talk about?
Well, yes. I mean, here we have to put things in perspective. I mean, central bank independence, what it means is a delegation of the use of some policy instruments to pursue a very specific objective to an institution, to a group of people. Now, when you, as a country, the intelligence of the nation to delegate it to a group of people is because you presume that they will have a responsible management of those instruments. And at the same time, it means that there is at least some degree of discomfort of having those authorities to lay in the traditional political group who is managing a country. Now, if you consider that it is in its own design that there will be some tension, because I mean you're taking away the ability to do certain things to, let's say, the ruling group and delegating it to somebody else. So, I mean, it's natural to think that there will be tensions. If there was not going to be tension, then it really doesn't make any sense to have the autonomy.
Right.
So the real difficulty is to assess how much is too much. I mean, also we have to say, I have to say that many of the autonomy statutes or the statutes of the different central banks have a fair amount of protection. I mean, for example, when you have staggered members in the decision body, I mean, take the US, I mean, you have the layers of the presidents of the districts, you have a 7-member board, they are substituted in a staggered way. It's very difficult that the takeover can be engineered.
Right.
So there are defenses, and those defenses are there because the legislators, when they considered this issue, they anticipated that there were going to be some tensions, and that at some point, you know, the central bank would need those defenses. At the end of the day, the bottom line of all of this is if really there is public support for the autonomy of the central bank. If there is no public support, eventually laws can be changed and the autonomy will change. Now, do I see a weakening in this public support to the autonomy of the central banks? I would say that support is there. And I mean, obviously, when you introduce so many actions, you engineer such a broad intervention, you cannot control all the results. There are some unintended consequences, probably the issue of distribution and so on. Those raise some issues, but that cannot fully be assigned or allocated to, or make the central bank fully responsible for them. So at this stage, I mean, I still feel comfortable from the point of view that probably in all countries, from the vast majorities of the countries, if you would ask them, do you want to have an independent or not central bank, they would support the autonomy.
Monetary policy frameworks, the Fed has just held a conference in Chicago earlier this week where Jay and others looked at their framework. I know it's something that you've been writing about and talking about. How do you think about potentially different or new monetary policy frameworks given your seat at the BIS?
Well, I mean, I think it's very, I commend the Fed, I commend Jay Powell for this initiative, Rich Clarida. I mean, I think that after those 10 years of pretty much even innovating on the run, I mean, I think it's good to capitalize on this relative period of stability and take stock and rethink what comes next. And that is very, very important because so far what many central banks have been doing is going into uncharted waters. So it would be very productive, it is very productive to have this period of reflection to think what the next steps will be and to have, I would say, a more thoughtful way forward. No? So, I mean, I think that this move to unconventional policies have been very productive. I think many of those instruments, if not all, certainly will be there. We will have to be very mindful when those instruments can be used again. And at the same time, we need to think if there are certain new things that we need to do to be able to normalize in an appropriate ways in the years to come.
As you know, some of the key central banks, Federal Reserve, the ECB, the Bank of Japan, have had a difficult time achieving their inflation target. What does that tell us about maybe the target itself or the tools or means to achieve that target? And do you perceive that as a failure on behalf of those institutions?
Well, I mean, I think that there are many challenges in front of us. One is we need to be humble, and at least I myself, I recognize that we don't, or at least I don't fully understand the inflationary process in many advanced economies. I mean, we have good hints of what might be happening. I mean, we have the issue of the macro shocks and how they have been dealt with. But at the same time, we have issues like the demographic change, globalization, technology, the Amazon of this world. Are we measuring inflation in the right way?
Right, or productivity.
So I think that precisely this process of reflection will help us to dilucidate if we need to adjust the targets, we need to adjust the instruments, and so on and so forth. I mean, it's a puzzle, especially now when you see U.S. unemployment at 3.5%,
right.
Far below what the natural rate of unemployment is supposed to be, and that is pressuring a little bit wages, but not a lot. And even if those wage pressures are there, they're not being transmitted into prices.
Right.
So something is going on there that we need to further study it. We have good hints, and hopefully everything will be clarified as we move forward. I mean, we in central banking still believe that we have evidence that the Phillips curve is there, and the Phillips curve is usually the key component in the way we do our monetary policy. But yeah, I mean, so it's a time to reflect, and it's a time to recalibrate what we need to do in the years to come.
I want to turn to technology, since you mentioned before. Let me just ask you about debt levels. As you know, the IF, we accumulate debt statistics. We report on debt on a quarterly basis. We've seen in this cycle an increase of debt globally, 70 trillion since the crisis. We're now at 320% of GDP. We've seen increase in debt, household, corporate, sovereign level. Do you worry about current debt levels?
Well, I mean, certainly there are pockets where you really should be concerned. I mean, as debt increases, vulnerabilities increase. I mean, at this point, I wouldn't necessarily say that we are in an imminent crisis situation, but yes, we have to be very watchful.
I agree, and hopefully we'll get support for our debt transparency principles at the G20. I know that you and your colleagues are looking at those principles closely. Let me turn to technology. It seems like many conversations you and I have had over the last couple of years, technology has been the part or the central part of that conversation. You just put out a piece on June 3rd, and I'll just quickly quote you. So the first sentence, the future of central banking is inextricably bound to innovation. Then you go on to say, as guardians of financial stability, central banks are directly affected by, quote, a sea change in innovation in the financial sector and the infrastructure underpinning financial markets. So as head of the BIS, how are you thinking about innovation generally?
Well, I mean, I think it's a key task for us to think about in the future. I mean, the technology is moving very, very fast. It's being applied to financial transactions. It's even being applied to something that comes very close to central banking, which is to pseudo currencies.
Right.
I mean, therefore, and you know, it forces us to start thinking very actively in, for example, central bank digital currencies.
Right.
At this stage, I won't say there is a demand for them. There is demand for innovation in payments, and I think that can be satisfied with the two-tier system where the banking system and with associations with fintechs and so on takes care of the demand of the public, and the settlement takes place at the end of the day in the central bank. But you know, central banks need to be prepared. If people genuinely do not want to hold any more bills and coins in circulation, we need to be able to provide them some form of central bank digital currencies. I mean, you see very heterogeneous behavior of the demand for cash. You see the case of Sweden. or Norway or Denmark that is falling very fast. You see the case here of Japan or Germany, right, where the demand for bills is still very, very important. So central banks need to be prepared, and also we need to facilitate the application of innovation to reduce transaction costs, to increase inclusion. I mean, for emerging markets is very important. Something that I thought it was a very good decision of the Japanese presidency of the G20 is to include the issue of financial inclusion for elderly people. Mm-hmm. And the response there is fully technology. So we need to embrace it and support those efforts.
We've done a number of surveys of our membership on machine learning and AML, machine learning and credit risk. What we have found is we've traveled around the world on a roadshow describing the findings of our studies, is that many authorities see AI or machine learning as a bit of a black box and worry about data quality. How do you think about these new technologies? Are you suspicious? Are you embracing? And how do your counterparts think about them in terms of allowing the industry to use it for a variety of purposes?
Well, I mean, I think as every technology, you need to be able to at least have a very sophisticated idea of what you're doing with information. At the end of the day, you are manipulating information. AI is just a way, it's just a technology to manage huge amounts of data. Mm-hmm. Now, something that stuck in my mind is that this year, the lady, and sorry that I don't remember the name, it's the jet lag, the lady that won the Nobel equivalent of the Nobel Prize in mathematics, she said the following. She said, an algorithm is an opinion expressed in numbers. And here, what is important is the use of the word opinion.
Right.
Now, are we going to trust algorithms just because they are algorithms? Or do we want to know what is the opinion behind those algorithms? And I think that, for example, if those algorithms will be used for credit scoring or will be used for assessing key issues in finance, I think that we should be curious and find out what are the opinions behind those algorithms.
I met with one of our board members 2 weeks ago who told me they have 1,000 credit officers. They could reduce that to 50, from 1,000 to 50 by using simple off-the-shelf AI technology. Does the idea of going from 1,000 to 50 cause you some concern?
Well, again, I mean, if it's well done, I mean, I'm sorry for the 950 that lost their job. I mean, but at the end, is it efficient or not? And a lot will be efficient. I mean, we have to be frank and we have to embrace technology. But not all the technological changes are positive, and not all the technological changes give the results that they promise. I mean, we see it every day. I mean, there are many startups, there are hundreds of efforts that are out there that they just don't make it.
Right.
So, I mean, if you compare the success rate of many of these experiments, it's not that high. Therefore, I mean, I think that we need to have the ability to really identify those who will be path-breaking from the point of view of making the system more efficient, more cost-effective, but also more secure.
Right.
At the end of the day, we want that to be all together.
That's a nice segue into my next question about big tech firms. Mm-hmm. You know, lots of discussion about fintech, but many of them go out of business. As you said, some mature into vendors for many of our member firms, but there's several very large global institutions, Ant Financial for one, has a money market fund larger than JP Morgan, a market cap larger than Goldman Sachs. You and I have had this conversation. How do you view these incredibly large, well-capitalized institutions, global in scope, with hundreds of millions of customers? They're essentially in the financial intermediation business, but aren't really treated like financial intermediaries.
Well, I mean, yes, there are some asymmetries in the in the flexibility they have to use information. They have these huge network effects, network advantages. The role, I think, of regulators should be to obviously not protect, in the traditional sense, the incumbents, just for the sake of protecting them. But what is our obligation is to try to provide as level playing field as possible. Because I think that there are some important issues in competition, in the use of information, that are, I think, then together with financial regulation, that all needs to be coordinated to really provide a level playing field. And if the level playing field is there, we will see who prevails at the end. But I certainly think that at least we need to assure that.
Yeah, my last question, we're running out of time, is going back to the panel that preceded us was focused on market fragmentation. The FSB and IOSCO just came out with a report the night before last. A very good assessment led by the Japanese with respect to market fragmentation. Do you worry about market fragmentation? And if so, how might it manifest itself in ways that affect the way you do your job?
Well, I mean, I think it's, I welcome the fact that we are having this discussion right now. I mean, it's impossible to think that we will be able to coordinate everything at the national and international level, and that some form of friction will not be there as we implement it. So that's why the Basel Committee of Bank Supervision, the FSB, provided this window of opportunity, with this window of time, to evaluate, to examine, and also that also explains why the full introduction of these reforms is staggered through time. I mean, the key issue is also that genuine consultation, genuine difficulties in implementing are not confused with deliberate effort to dilute the reforms. So we need to have the smarts to identify what are genuine impediments to implement fully the reform and what are more explicit efforts to dilute it.
Agustín, I got through page 1 of 4 pages of questions, but we're out of time. Maybe we can follow up our conversation somewhere else. But as always, you've been a good friend to us and to me over the years. I appreciate you taking the time, having just flown in this morning, to come by and spend a few minutes with us. Ladies and gentlemen, Agustín Carstens from the BIS.
Thank you.